Welcome to Education Unleashed, the podcast that doesn't just drop knowledge, it slams it into your skull like a financial sledgehammer. Today, we're ripping open the playbook of Warren Buffett, the Oracle of Omaha, the guy who took a measly $10,000 and spun it into a $30 billion empire. This isn't some Wall Street fairy tale about a wizard waving a wand. No, this is a masterclass in value investing, compound interest, and a mindset so sharp it could slice through the noise of every TikTok stock guru combined. Buckle up because we're about to unpack the exact strategy that built Berkshire Hathaway, and it's going to make your brain do backflips. Let's start with the big question. How does anyone turn pocket change into a fortune that could buy a small country? Is there a secret handshake, a magic formula? Back in 1999, when Buffett was already richer than most nations' GDPs, some wide-eyed fan had the guts to ask, "Hey Warren, how do I get to $30 billion? And Buffett, with that sly grandpa next door smirk, just says, "Start young." Boom, mic drop. Sounds like a throwaway line, but don't be fooled. This is the cornerstone of his entire philosophy. He's not joking. He's talking about the snowball effect, compound interest so ferocious it's like a kid's tiny snowball turning into an avalanche that buries a village. You start small, roll it through time, and watch it pick up steam. The longer the hill, the bigger the boom. Lesson 1. Time is your ultimate weapon, and procrastination is your worst enemy. Now, let's break this snowball idea down because it's not just a cute metaphor, it's a financial nuke. Imagine you're a kid packing snow, rolling it around, and it's tiny at first, but every roll picks up more snow, and suddenly it's a boulder tearing down the hill. That's compound interest in action. Your money earns money, and then that money earns more money, and it keeps stacking like a runaway freight train. Buffett's obsessed with this because it's not about how much you start with. It's about how long you let it roll. Start at 20, and by 60, your snowball's a monster. Start at 40, and you're playing catch-up. The math is brutal and beautiful. $1 invested at 10% annually becomes $2.59 in 10 years, $6.73 in 20 years, and a jaw-dropping $45.26 in 40 years. That's not investing, that's sorcery. And Buffett's been riding this wave since he was in short pants. But what if you're not a teenager with a paper route and a dream? What if you're staring down 40 with $10,000 burning a hole in your pocket? Don't cry into your latte, Buffett's got you covered. He says even with a modest stack, you can still play the game. His advice, go for the small companies. The big dogs, think Apple, Coca-Cola, everyone's got their eyes on them, bidding up their prices like it's a Black Friday sale. But those smaller companies, they're the hidden gems, the $20 bills tucked in the pocket of a thrift store jacket. They're often overlooked, undervalued, and ripe for the picking. Buffett's not saying bet the farm on some sketchy startup. He's saying find the small players with big potential, the ones the market's sleeping on. That's where the real bargains live. Now, hold up. Buffett's not some nostalgic grandpa pining for the 1950s when he could buy a company for pocket change. He knows the investing world's changed. Back in his early days, finding a bargain was like shooting fish in a barrel. Markets were less efficient, information was slower, and Buffett could swoop in like a hawk. Today, with algorithms and hedge funds sniffing every corner of the market, it's tougher. But his core idea still holds, and he's so confident it's timeless, he thinks it'll work a century from now. What's the idea? Buy good businesses or little pieces of them called stocks at a price that makes sense. Don't overpay, look for real value. It sounds simple, but it's a machete that cuts through the hype of every crypto bro and day trading influencer out there. So what makes a business good in Buffett's world? This isn't about liking their logo or their Super Bowl ad. Buffett's got a framework, and it's surgical. He's hunting for companies with a moat, a competitive advantage so strong it's like a medieval castle surrounded by alligator-infested waters. That moat could be a killer brand like Coca-Cola, where people would rather drink sugar water than switch to a knockoff. It could be unique tech like Apple's ecosystem that traps users in a gilded cage. Or it could be a loyal customer base like Costco where people pay to shop because they're obsessed. The moat protects profits, keeps competitors at bay, and ensures the cash keeps flowing. Without a moat, a company's just a sitting duck waiting to be eaten by the next disruptor. But how do you spot a moat? This is where Buffett turns into a detective. He's not swiping through a trading app, impulse buying stocks like they're on Amazon Prime. He's deep in the trenches, reading financial statements, dissecting industries, talking to customers, even scoping out competitors. It's like he's buying a house, kicking the tires, checking the plumbing, making sure the roof doesn't leak. You wouldn't drop 6 figures on a fixer-upper without a walkthrough, right? Same with stocks. Buffett's doing the homework, so he knows exactly what he's getting. And he's not just looking for any company, he's looking for the ones the market's mispriced, the designer handbags at the thrift store, the businesses trading way below their intrinsic value. Intrinsic value? Yeah, it sounds like finance jargon, but it's the heart of Buffett's game. Every business has an intrinsic value, what it's truly worth based on its assets, earnings, and future potential. Think of it like a hidden price tag only smart investors can see. Buffett's mission is to buy when the market price is a screaming bargain compared to that intrinsic value. It's like finding a $1,000 suit on clearance for $200. The market might be sleeping on it because of bad PR or a temporary hiccup, but Buffett knows the real worth and pounces. That's value investing in a nutshell. Buy low, hold long, and let the market catch up to reality. This isn't a get-rich-quick scheme. Buffett's not promising Lamborghinis by next Tuesday. His whole deal is patience, discipline, and letting that snowball roll. You find companies with strong moats, buy them at a discount, and then sit back while time and compounding work their magic. It's not sexy, but it's devastatingly effective. And the best part, Buffett swears anyone can do this. You don't need a PhD or a corner office on Wall Street. You just need curiosity, a willingness to learn, and the guts to stick to the plan when the market's screaming at you to panic. So we've got moats, intrinsic value, and the snowball effect locked in. But how does this guy actually find these hidden gems? And what's the deal with his obsession with patience? Spoiler alert. It's not just about sitting on your hands, it's about swinging for the fences when the pitch is perfect. Buffett's research process is like a CIA operation. He's not just skimming Yahoo Finance or trusting some talking head on CNBC. He's diving into the guts of a company, its balance sheets, income statements, cash flow reports. He's reading annual reports cover to cover, probably with a highlighter and a cup of Coke, because, he's got that Coca-Cola obsession. He's studying the industry, the competitors, the customers. It's not enough to know a company makes cool gadgets. He wants to know if they're built to last, if their moat is deep enough to fend off the barbarians at the gate. This isn't casual browsing, it's a full-on autopsy to find out what makes the business tick and whether it's worth his cash. And here's where Buffett separates himself from the herd. He's not chasing trends. He's not piling into the latest meme stock or crypto coin because it's hot. He's looking for businesses he understands, ones where he can predict their future with reasonable confidence. That's why he loves boring companies like insurance, railroads, or consumer goods. They're not flashy, but they're predictable, and predictability is gold in investing. You think Buffett's losing sleep over the latest AI startup? Nope. He's betting on companies like See's Candies, which has been churning out peanut brittle since your grandma was a kid. Why? Because people will always buy candy, and See's has a moat wider than the Grand Canyon. Now, let's talk about that baseball analogy because it's pure Buffett genius. He says, investing is like standing at the plate in a baseball game where there's no umpire calling strikes. You can let pitch after pitch go by, crappy stocks, overpriced tech, sketchy penny stocks, and you don't have to swing. You just wait for the perfect pitch. A great company at a bargain price. When it comes, you swing hard. This is where patience meets aggression. Most investors are swinging at every pitch, chasing hype, panic buying, panic selling. Buffett, he's chilling, waiting for his moment, and when it hits, he's all in. That's how he snagged massive stakes in companies like American Express and Geico by waiting for the market to undervalue them and then pouncing like a financial panther. But let's zoom out and talk about Buffett's origin story because this guy wasn't born with a silver spoon in a Bloomberg terminal. He was a hustler from the jump. As a kid, he was selling chewing gum, delivering newspapers, even running a pinball machine business. Picture a young Warren, barely taller than a lemonade stand, slinging papers to Babe Ruth's house. Yeah, that Babe Ruth. Talk about an epic flex. By 11, he was already buying stocks, dipping his toes in the market while most kids were collecting baseball cards or, let's be real, Pokemon cards. His first investment? 3 shares of Citi's Service Preferred at $38 a pop. The stock tanked to $27, then rebounded to $40, and he sold for a small profit. Lesson learned, don't jump ship too early. That early win and loss lit a fire in him, teaching him patience, discipline, and the value of holding for the long haul. What's wild is that Buffett wasn't some prodigy with a secret sauce. He was just a kid with a crazy work ethic and a brain that wouldn't quit. He didn't have a fancy degree or a Wall Street pedigree when he started. He had curiosity, a library card, and a knack for numbers. By his teens, he was devouring books like Benjamin Graham's The Intelligent Investor, which became his investing Bible. Graham taught him the gospel of value investing, buying businesses for less than their worth, and Buffett ran with it, turning it into a multi-billion-dollar art form. His early hustles, from paper routes to stock picks, weren't just about making a buck, they were about learning the game, building the mindset that would make him a legend. So, What's the takeaway from Buffett's early days? You don't need to be a genius to start investing. You don't need a trust fund or a corner office. You need a spark, curiosity, discipline, and the willingness to learn from your mistakes. Buffett's proof that anyone can play this game if they're willing to put in the work. He's not gatekeeping his strategy, he's shouting it from the rooftops. His annual letters to Berkshire Hathaway shareholders are like free MBA courses packed with insights on how to think like an investor. You just have to be willing to read them. Let's circle back to the big picture. Buffett's approach is all about long-term thinking. He's not trying to flip stocks for a quick buck. He's buying businesses he believes in at prices that make sense and then letting them grow for decades. It's like planting a tree. You don't dig it up every week to check the roots. You water it, give it time, and watch it turn into a giant oak. That's the power of compounding, and it's why Buffett's so obsessed with starting early. The sooner you plant, the bigger the tree. But even if you're starting later, the principles still work. You just need to be patient, pick the right seeds, and let time do the heavy lifting. We're deep in the Buffett rabbit hole now, and it's time to hammer home what makes his strategy so idiot-proof yet so devastatingly effective. This isn't about chasing rainbows or betting on the next Tesla. It's about building wealth with the kind of discipline that makes Navy SEALs look like slackers. Let's dive into how Buffett picks his winners, why he's so obsessed with moats, and why his approach is a middle finger to every get-rich-quick scheme out there. First, let's double down on this moat concept because it's the backbone of Buffett's picks. A moat isn't just a cute buzzword. It's a fortress that keeps a company's profits safe from the wolves. Take Coca-Cola, one of Buffett's darlings. Why's it got a moat? Because people don't just drink Coke, they're practically married to it. You could launch a new soda tomorrow, but good luck convincing billions of people to ditch their fizzy soulmate. That brand loyalty is a moat. Or look at Apple. Its ecosystem is a moat so deep it's practically a black hole. Once you're in with an iPhone, Mac, and AirPods, switching to Android feels like moving to Mars. These moats mean steady profits, year after year, no matter what the economy's doing. That's what Buffett's after. Businesses that can weather storms and keep the cash flowing. But spotting a moat isn't like flipping a switch. It takes work, serious work. Buffett's not just eyeballing a company and saying, yup, looks moaty. And he's tearing apart their financials, looking at profit margins, debt levels, return on equity. He's asking, can this company keep its edge for 20 years, 50 years? He's studying the industry to see if disruptors are lurking. He's even chatting with customers to gauge loyalty. It's like he's building a dossier on every company he touches. And here's the kicker. He only invests in businesses he understands. If he can't wrap his head around a company's model, say some bleeding-edge biotech or a crypto startup, he's out. He's not gambling on hype, he's betting on clarity. Now let's talk about price, because even the best company's a dud if you overpay. This is where intrinsic value comes back into play. Buffett's not just buying great businesses, he's buying them at a discount. Intrinsic value is like the true worth of a company based on its assets, earnings, and growth potential. The market price? That's just what the crowd's willing to pay on any given day, and crowds are often dumber than a bag of hammers. When the market's in a panic, say during a recession, great companies can get priced like junk. That's when Buffett strikes, scooping up bargains like a kid at a candy store. It's not about timing the market, it's about exploiting the market's mood swings. This brings us to one of Buffett's superpowers, emotional discipline. Most investors are emotional wrecks, buying high on greed and selling low on fear. Buffett, he's a robot. When the market's crashing, he's shopping. When everyone's hyped, he's skeptical. During the 2008 financial crisis, while Wall Street was having a collective meltdown, Buffett was writing checks for Goldman Sachs and General Electric, snagging deals at fire sale prices. Why? Because he knew their intrinsic value hadn't changed. Only the market's mood had. That's the kind of ice-cold nerve that turns $10,000 into $30 billion. But here's what makes Buffett's strategy so accessible. You don't need to be a financial Einstein to pull it off. His principles are simple: buy good businesses at good prices and hold them for the long haul. The hard part is the discipline. It's about ignoring the noise, the headlines, the FOMO. It's about doing the homework, waiting for the right pitch, and not freaking out when the market dips. Buffett's not some untouchable genius. He's a guy who reads, thinks, and sticks to his knitting. And he's adamant that anyone can do it. His famous line, "You don't have to be a rocket scientist. Investing is not a game where the guy with the 160 IQ beats the guy with the 130 IQ. Let's talk about Buffett's journey again, because it's not just inspiring, it's a blueprint. He started small with no safety net. His early investments weren't home runs, they were learning curves. That Citi's service stock at 11? He made a profit, but he sold too soon, missing a bigger gain. That taught him to hold tight to good businesses. His paper route, his gum-selling hustle, Those taught him the value of hard work and cash flow. By his 20s, he was running his own investment partnership, pooling money from family and friends to buy undervalued stocks. He wasn't flashy, he was relentless. And when he took over Berkshire Hathaway, a failing textile company, he didn't just revive it. He turned it into a holding company for his greatest hits, from Geico to Dairy Queen. What's the lesson? Start where you are. You don't need millions to begin. You can start with $100, $1,000, whatever you've got. Use fractional shares if you have to. The key is to start learning, start researching, start planting those seeds. Buffett's not saying you'll be a billionaire by Friday, but he's saying the principles that built his fortune are universal. Find companies you admire, ones with products you love or problems they solve. Dig into their financials, their management, their moats. Look for bargains and don't be afraid to wait. The market's always throwing pitches. You just need the patience to swing at the good ones. It's time to tie this Buffett masterclass together with a bow made of pure, unfiltered truth. This isn't just about investing. It's about a mindset that can transform how you think about money, time, and opportunity. Let's unpack the final pieces of Buffett's strategy, slam the door on get-rich-quick fantasies, and give you a call to action that'll light a fire under your financial future. Buffett's obsession with long-term thinking is what sets him apart from the Wall Street circus. He's not playing for next quarter's earnings or next year's IPO pop. He's playing for decades. When he buys a stock, he's not thinking about selling it. He's thinking about owning it forever. Why? Because great businesses with strong moats and steady cash flow don't just grow, they compound. They're like oak trees, getting stronger and more valuable every year. Take his stake in Coca-Cola. He bought it in 1988 for $1 billion, and today it's worth over $20 billion plus decades of dividends. That's not a trade, that's a legacy. Buffett's not flipping houses, he's building castles. This long-term mindset is why Buffett laughs at market predictions. Will the Dow hit 50,000? Will a recession tank everything? He doesn't care, he's not trying to time the market or outsmart it. He's buying businesses so good they'll thrive no matter what the headlines say. During the dot-com bubble, when everyone was losing their minds over tech stocks, Buffett sat it out. People called him washed up, a dinosaur. Then the bubble burst, and he was the one still standing, scooping up bargains while others licked their wounds. That's the power of focusing on value over hype. Trends come and go, great businesses endure. Now, let's talk about mistakes, because even Buffett's not perfect. He's made plenty. Buying a failing airline, overpaying for craft, missing early bets on tech like Amazon. But here's what makes him different. He owns his mistakes, learns from them, and moves on. He doesn't double down on bad bets or cry over spilled milk. He analyzes what went wrong, adjusts, and keeps swinging. That's a lesson for all of us. Investing isn't about being flawless. It's about being resilient. You'll pick some duds. You'll miss some winners. The key is to keep learning, keep researching, and keep your eye on the long game. So, what's the biggest takeaway from Buffett's $30 billion snowball? It's this. Wealth isn't built by chasing shiny objects or hacking the system. It's built by finding great businesses, buying them at fair prices, and letting time and compounding do the rest. It's about planting trees today that'll shade you tomorrow. And the best part, you don't need to be Warren Buffett to do it. You don't need his brain, his bank account, or his track record. You need his principles: curiosity, patience, and discipline. Buffett's not hiding the playbook. He's practically begging you to use it. Here's your call to action, because listening to this podcast isn't enough. Start learning today. Pick up The Intelligent Investor by Benjamin Graham or read Buffett's shareholder letters online. They're free and better than any finance course. Start small. Look at companies you know, ones whose products you use or whose problems you admire. Check their financials on sites like Yahoo Finance or SEC filings. Look for moats, strong brands, loyal customers, unique tech. Ask yourself, is this company built to last? Is it priced like a bargain? If you don't know where to start, consider index funds. Buffett loves them for beginners because they're low cost and diversified. Then take the leap. Open a brokerage account. Start with whatever you can afford. $100, $1,000, doesn't matter. Buy a piece of a company you believe in and let it grow. Don't check the stock price every day. That's a recipe for insanity. Focus on the business, not the ticker, and be patient. Buffett's snowball didn't become an avalanche overnight, and yours won't either. But every day you wait is a day you're not rolling. This is the beauty of Buffett's approach. It's democratic. You don't need a Wall Street pedigree or $1 million. You need a brain, a plan, and the guts to stick with it. Buffett's living proof that anyone can build wealth with the right mindset. He started with $10,000 in a dream, And he's still out there at 94 buying businesses and compounding like a boss. If he can do it, so can you. Let's start with a harsh truth. Most investors are their own worst enemies. They're not losing because the market's rigged or because they don't have Buffett's billions. They're losing because they're impatient, emotional, and addicted to the thrill of the chase. Day trading? It's like playing poker with a marked deck against you. Crypto pumps? Good luck timing the exit before the rug gets pulled. Buffett's strategy is the antidote to this madness. He's not trying to outsmart the market's daily mood swings. He's ignoring them. He's buying businesses so rock solid that a market crash is just a clearance sale. Take his investment in American Express during the 1960s salad oil scandal. The stock tanked over a fraud scare, but Buffett saw the moat. Amex's brand and customer trust were untouchable. He bought in cheap, held tight, and turned a crisis into a cash machine. That's not gambling, that's genius. Now, let's talk about diversification, because this is where Buffett flips conventional wisdom on its head. Most financial advisors scream, diversify, spread your bets. Buffett? He laughs. He's not saying put all your eggs in one basket, but he's definitely saying pick a few great baskets and watch them like a hawk. His portfolio isn't a sprawling mess of 500 stocks. It's a concentrated punch of heavy hitters like Apple, Coca-Cola, and American Express. Why? Because if you've done the homework and found a company with a bulletproof moat and a bargain price, why dilute your returns with a bunch of mediocre bets? Diversification protects against ignorance, but Buffett's not ignorant. He's done the legwork. For you, this means focus on quality over quantity. Don't own 50 stocks because some blog told you to. Own a handful of great ones you've researched to death. But here's the catch. Researching to death doesn't mean paralysis by analysis. Buffett's not sitting on a mountain of data overthinking every decimal point. He's looking for simple businesses with clear advantages. He loves companies like See's Candies because their model is dead simple. Make great candy, sell it at a premium, keep customers hooked. No PhD required to understand that. Compare that to some AI startup with a 200-page white paper and a CEO who sounds like a TED Talk on steroids. Buffett's passing on that noise. For you, this means stick to what you know. If you're a tech nerd, dive into software companies. If you love fashion, study retailers. Invest in your circle of competence and don't get suckered by hype you don't understand. Let's zoom out and tackle one of Buffett's biggest warnings. Avoid debt like it's a plague. He's not just talking about personal credit card debt, though yeah, ditch that too. He's talking about companies that are leveraged to the gills. A business with a great moat can still sink if it's drowning in loans. Buffett loves companies with clean balance sheets, ones that can survive a recession without begging for a bailout. Look at Berkshire Hathaway itself. It's a cash fortress sitting on billions it can deploy when opportunities arise. For you, this means scrutinizing a company's debt-to-equity ratio before you buy. If they're borrowing like a college kid with a new credit card, run. Now, let's get practical. Say you're ready to start $5,000 in your account, itching to build your snowball. Where do you go? First, educate yourself. Buffett's shareholder letters are gold, but you can also check out books like The Essays of Warren Buffett or Buffettology. Next, pick a brokerage. Schwab, Fidelity, Robinhood, whatever. Look for low fees because high commissions are a wealth killer. Then start scouting. Use free tools like Morningstar or Yahoo Finance to check financials. Look for companies with consistent earnings, low debt, and a competitive edge. Maybe it's a boring utility company or a consumer staple like Procter & Gamble. Doesn't matter if it's not sexy. What matters is the moat and the price. And here's a pro tip. Don't obsess over stock charts. Those squiggly lines are a distraction. Focus on the business. Is it growing? Is it profitable? Does it have a moat that'll last a decade? If the answer is yes and the price is right, buy and hold. Ignore the market's tantrums. Buffett didn't become a billionaire by refreshing his portfolio app every hour. He did it by betting on businesses he believed in and letting them compound. You can do the same. First, let's tackle the myth that Buffett's strategy is outdated. Critics love to whine that value investing doesn't work in today's tech-driven, algorithm-fueled market. They point to Tesla's insane run or Bitcoin's moonshots and say, see, Buffett's a fossil. Wrong. Buffett's not anti-tech. He owns a massive chunk of Apple, one of the biggest tech bets in history. What he's anti is overpaying for hype. When he bought Apple in 2016, it wasn't a sexy startup. It was a cash-gushing giant with a moat deeper than the Pacific. The stock was trading at a reasonable price relative to its earnings, and Buffett saw the value. Today, that stake's worth over $100 billion. Value investing isn't dead, it's just misunderstood. And it's not about buying cheap stocks, it's about buying great businesses at fair prices, whether they're tech, retail, or railroads. This brings us to a critical point. Timing, not market timing. Buffett thinks that's a fool's game, but the timing of when you start investing. Every day you delay is a day your snowball's not rolling. Let's crunch some numbers to make this real. Say you're 30 and you invest $10,000 at an 8% annual return. By 60, that's $100,027. Wait until 40 to start? You're at $46,010 by 60. That's half the wealth for the same effort just because you sat on your hands for a decade. Time isn't just money, it's exponential money. Buffett started at 11, which is why his snowball is a planet-sized wrecking ball. You don't need to be 11, but you need to be now. Open that account, buy that first share, plant the seed today because tomorrow's already costing you. So how do you build this Buffett mindset? Start by consuming knowledge like it's oxygen. Read his shareholder letters, follow investors like Charlie Munger, Buffett's right-hand man, and study companies you admire. Practice analyzing businesses. Pick one like Nike or Starbucks and ask, what's their moat? Are they overpriced? What's their debt like? This isn't just homework, it's training your brain to think like an owner, not a gambler. Next, set a goal. Maybe it's $100,000 by 50 or $1 million by retirement. Reverse engineer it. How much do you need to invest monthly at what return to hit it? Then execute. Automate your investments if you can. Set up a monthly buy into an index fund or a stock you love. Make it a habit, like brushing your teeth. Let's wrap with a final call to action because knowledge without action is just trivia. Today, pick one company you love. Maybe it's Disney, Starbucks, or a local business you admire. Go to their investor relations page, download their latest annual report, and start reading. Look for their moat, their earnings, their debt. Ask, is this a business I'd own for 20 years? Then check the stock price on a site like Google Finance. Is it trading below its intrinsic value? If you're not sure, keep studying. Join forums like Seeking Alpha, follow investors on X, and soak up knowledge. Then act. Buy a share, even a fractional one. Start your snowball, because every day you wait is a day you're not growing. Buffett's $30 billion empire started with $10,000 and a kid who dared to dream big. You've got the same shot. His rules: find value, stay patient, think long-term, are universal. They work in bull markets, bear markets, and everything in between. They work for stocks, for careers, for life. So go out there, build your moat, roll your snowball, and own your future. The Oracle's shown you the way. Now it's your turn to run with it.